Do you think everybody could be getting it wrong again? I mean, we started last week with a surge in oil prices, all because of the Nigerian conflict.
Well, good morning, Kathy. Yes, it's certainly been a roller coaster ride over the last couple of weeks. You know, down at $98 probably 4 or 5 weeks ago, all the way to $120. Seen a little bit of a correction and earlier last week, and then, as you mentioned, Nigeria and a couple of other geopolitical concerns. But I think from where it's trending at the moment, we think it'll be further down around that 105, 110 level in the next couple of weeks, Kathy.
Is that the case? I mean, we're getting positive news out of the U.S. Prices were up more than $3 a barrel on Friday because of those better-than-forecast U.S. jobs report.
Yeah, exactly. Look, there's no doubt about it, Kathy. Over the long term, we're going to see far higher oil prices, and the world's just got to be aware of that. And as you're aware, you know, the T-boon pickings, all the alternatives, the biodiesel, you're looking at, you know, new energies. It takes so long to come online, and we've seen that flow across to the soft commodities. But the big picture is more consumption, and I'm sure the North Americans will be staying home this year, won't be travelling and be driving motor cars more than ever, Kathy.
Yeah, but what about when it comes to the dollar? The dollar's ascent couldn't be a good thing for oil, or could it? I mean, crude oil still picked up pace despite the dollar's gains on the euro last week. Yeah,
you know, well, it's been a meltdown over the last probably couple of years, and certainly in the last 8 months, it's really, you know, ratcheted down the US dollar. It seems to be level peg, going a little bit sideways, and it seems to be appreciating against the euro. So it's going to be interesting where it trends over the next couple of weeks. But if the dollar does gain some more strength, and we've seen that flow across to the equity markets in the last couple of weeks, then we could see the oil market level back. I'm sure that it's all been hedging very much upon where the euro trends, Kathy.
So level back to what ranges before it starts shooting up again?
Well, we're saying 105, 110, Kathy. That's where we're picking it, and we're, you know, putting our line in the sand for that sort of number. Nat gas to come back as well, and heating oil as well, Kathy. Are we not going to see $120 a barrel again, at least in the short term? Oh, yeah. Definitely. I think by the middle of the year, I think we'll be there as growing consumption out of the States, and then that leads us into the hurricane season, which happens every year, and you know, other major contributing factors. We've really got zero geopolitical at the moment. We haven't got any problems with lines or any major distribution problems. So at the moment, it's sitting fairly tight in this range. But in the longer term, Kathy, far higher from here.
Break down more of the inventory numbers. We're joined by Stephen Schork, president of the Schork Report. He comes to us from Philadelphia this morning. So, Stephen, let's make sense of it. Rising imports as we see it, so crude oil supplies up, but you're really keyed in on that refinery utilization, and that dropped. What does it tell us?
Absolutely. It is now just a major question mark with regard to the integrity of U.S. refining capacity. As we are just a few weeks now away from the Memorial Day holiday and the start of gasoline driving season, there is real doubt on whether or not U.S. refiners have the capacity to offset all this increased demand that we always see in the summer. So this is ultimately an extremely bullish number in my respect. And it's also interesting, Monica, because capacity utilization, the demand for crude oil by U.S. refiners is quite low at just around 85% of capacity. But we've now had a third straight week of imports in excess of 10 million barrels a day. Now, that's very interesting because if you're a U.S. refiner, there's no way you're going out and building inventory at $120 a barrel that you expect to have that inventory sitting in. So if you're the refiner, what this is telling us is the refiners do expect to burn all of that excess oil. So it's actually a bullish number on both respects. The imports are telling us that the refiners are geared up and there is real demand for crude oil. That is certainly supportive of prices. And the poor refinery rates relative to historical metrics are telling us that we don't have the capacity to get enough gasoline on the market. So it's a bullish number both from the crude oil standpoint and from the refined product standpoint.
Yeah, interesting take on it because, of course, a trader on the floor, you heard with Sue Keenan saying that, you know, we could blow past, 125? She said, is 130 possible? You think 130 a barrel on crude is possible?
Absolutely. This market has been defined by $10 ranges, defined by on the O's. So that we broke through the last range, $120 last week with the May expiration. We retraced a little bit back down to the bottom of that range, 110, and then we blew right through it again this week at 120. So we are now in the next range, 120 So 119 is probably the bottom, and the market is setting its sights now on the top of that range, up between 125, 130. It is certainly within the realm. I absolutely am on board with the minister from Libya. We certainly could see 125 by this week. We could see 130 by the Memorial Day holiday.
Let me ask you about the dollar. We had seen it strengthen. Today we're seeing it up as well versus the euro. In past, when we've seen that, we've seen prices pull back a little bit. Didn't really see that today. I mean, they're down just a hair, but I mean, as everybody's saying, the tone is still bullish.
Absolutely, it is, because now what has happened with crude oil and with the bulls and the tech speculators, they did a great job in February, March when crude oil demand was low. They kept crude oil above $100. Now we are at the position where refiners are coming out of their maintenance and they're going to have to start ramping up their production for gasoline. So now there's real fundamental demand coming into the market. So now we're going to hear less about the dollar crude oil relationship, because now there's real fundamentals in the market. And again, with those imports coming in, that's telling us there is demand for crude oil in the market. So we're going to, again, hear less about the dollar, more about the fundamentals for the next month and a half as we ramp up for the peak driving season.
Stephen, talk to me about the distillate supplies, because we saw a draw there, and I'm just wondering, I mean, that's associated with heating oil, but at this point, should we be seeing a draw like that?
That is an absolute major concern, and this is a knock-on from the poor gasoline margins. Refiners simply don't have the economic incentive to maximize their gasoline production. And given that the fact that gasoline yields the largest percentage of the barrel, as goes gasoline production, so goes distillate production, heating oil production. So we had a major drawdown in heating oil supplies this winter. There is major concern that if we don't see a rebound in gasoline margins, refiners are not going to maximize that production, and therefore they're not going to maximize their distillate production. It's going to be a major headache for heating oil distributors in the Mid-Atlantic and the Northeast this summer to restock all that heating oil they need to replenish to get ready for next winter. Hence why heating oil now is trading at a premium to gasoline. It's a major problem right now.
Stephen, thanks.